Welcome back. It's a Friday morning here on Squawk Asia. Looking at a bit of a pullback on Wall Street overnight. Mixed or flat finish. So just a so-so lead for Asian markets. The state of the Dow added 19 points and more. The S&P, though, slipped to 2.25. The NASDAQ down by about 9.5 points. Let's get to our guest host for this hour, Yu-Dee Chang. Back with us, principal, also chief trader, Ace Investment Strategist. He joins us live out of Washington, D.C. Yu-Dee, great to see you. As always, appreciate your time. What'd you make of the market today?
Well, it's kind of interesting market today, right? For the third day in a row now, the market is pulling back a little bit. I think it's the sort of this short-term and intermediate-term type of story. I think over the short-term basis, especially going into the month of April, I'm actually a little bit scared of the market. Looking at the low VIX, a little bit of complacency in the market, and looking at the world event, I personally think we'll be seeing a correction in this market. However, over on a longer-term basis, I like the market. We saw a little bit stat here recently saying that this first quarter of 2012 was almost past, right? One more day. So S&P is almost up 12%. Now, There's been 13 years in the past since 1950s that the S&P has gained more than 8%, okay? Every single time for the year, it finished higher and much higher. So for the course of this year, I like it, especially if we could get a correction.
All right, but you're looking for that correction. So talk to us in terms of levels. Where would you be tempted to go back in?
Yeah, I think correction-wise, if you look at the past corrections, I think minimally somewhere between 7 to 8%. I think maximally maybe somewhere around 15%. I still do believe this risk trade is in place. The U.S. Fed is keeping interest rates so low, forcing people to take the risk to get some yield. So I think a lot of money is still sitting there waiting to buy in this market. So I'm thinking somewhere between 7 to 15%.
7 to 15%, which would put the S&P 500 at about...
Are you calculating? Or am I calculating?
Yeah. Well, I'm trying to get you to calculate because I'm just awful at math.
Well, S&P is around, 1,300? S&P is around 1,300, so we're talking about maybe another 70 points or so.
70 points or so. Okay. Listen, the whole thing with monetary policy and rates, though, nobody can really figure this out, whether the Fed really means it lower for longer into 2014, because, we've had Fed funds futures starting to slowly price in a hike end of next year, not 2014. And you take a look at the, say, the 10-year yield. Okay, fine, it was at 240. It's back down to below 220. But, there was a time not so long ago, days ago, when people were starting to have second thoughts. What do you figure?
Yeah, I think interest rate-wise, I actually agree with what you just said. The Fed is probably eventually going to raise rates prior to the end of 2014. So I'm thinking actually maybe even toward the beginning of 2014 or so. That's why you're saying the market start to factor in a little bit of rates already. But again, if you look at the world economy right now, Martin, is very interesting. Still very much in 3 different zones, right? U.S. is sort of chugging along, as evident today, about 3% GDP. Spain, if you look over to Europe, Spain is in their second recession since 2009, of course, not to say about Italy and also Greece, right? So that economy is still not doing that well. Now you start to hear the slowdown of China. So if all this come true, slowing down of China, maybe a slowing down of Europe, maybe the Fed will keep rates low until 2014 with the end of it. It's going to be very interesting to see.
Yeah, and layered on top of all of this, of course, worries about slowing global growth, not least exacerbated by the kind of prices we've seen in oil, although we have seen a pullback the last 2-3 sessions or so. But you think there's a good way to play this. Your house, ACE, you've got your energy sector hybrid approach, your ESHA program. Talk to us about that. What's that all about?
Yeah, we're taking a slightly different approach. Most people are either long or short. They think, okay, price of oil is going higher, so let's buy oil. Well, price of oil is going lower, let's short oil. In our opinion, if you look at the oil market, Martin, basically it's been oscillating in quite a huge range. Back in 2008, it was at about $150 a barrel. From there, it fell to about 35. From 35 went to 110. From 110 came down to 76. We think the price of oil will have a underlying a bullish tone to it. However, there are so many cross currents. We're talking about a possible conflict in the Mideast. We're talking about slowing down China. We're talking about all these major countries releasing their strategic reserve in accord, affecting oil prices up and down. So we believe there are three stages to the oil markets these days. It's going to trend higher, it's going to correct lower, and it's going to consolidate. Thus, we want to use various strategies, such as going long in a trending phase, maybe doing a cover call when it's correcting, and maybe it's selling options on both sides to utilize volatility to take advantage of the consolidation phase. That's why we want to take a slightly different approach to this with our program. And the program's actually been doing well. We like it.
Okay. All right. Sounds pretty smart tactically. Listen, a lot more to talk to Yu-Dee Chang about from Ace Investment Strategists. Excuse me. He's going to be with us the full hour. Got a question for him? Email us at squawk@cnbcasia.com. Yu-Dee, see it right there. We'll come back in just a bit. Still ahead on the show this morning, concerns about the Eurozone's debt situation. Yu-Dee was just talking about they're rearing its ugly head again on Spain's expected deep budget cuts. Details when we come back after these words. Welcome back. It's a Friday morning here on Squawk Asia. Creeping fears over Spain sent the country's bond yields higher overnight. Meantime, Italian yields also higher on the back of broadly positive debt sale. But all eyes are on Madrid, where the government today reveals its budget for the year ahead. Overnight clashes on the streets during a day of general strikes as workers pressure the government to back down on austerity measures.
Meantime, Spain is also facing pressure from European leaders fearful of financial contagion. Eurozone finance ministers meet today in Copenhagen, where expanding the region's bailout fund is high on the agenda. Now, it's thought they're trying to combine the lending capability of the temporary fund, the EFSF, with the permanent one, the ESM, that could see Europe's firewall expand to close to €1 trillion. Back with us now is our guest host this hour. Yu-Dee Chang is the principal and chief trader at Ace Investment Strategist, and he joins us live from Washington. Yu-Dee, we were just chatting offline about global risks out there in Europe when we were just talking about, but also you're saying more analysts in the U.S. are getting bearish on China. Tell us what they're worried about.
Yeah, they're really worried about the growth in China. And they're saying, first of all, you can't really trust the official numbers from China anyways, right? So they're saying, well, the growth of 7.5% is going to start dwindling down. And most recently, I even heard some business people coming on and saying that, hey, we actually do business in China, and we feel that their growth right now is definitely not 7.5%. They see the order flow, they think it's much, much lower. And they're worried about the Chinese factories, companies are carrying too much raw material inventories because they're not getting the orders from Europe and the U.S. So most people, especially in the U.S., they really are getting very, very bearish on China. I mean, I personally don't get that sense per se because I have a lot of friends and heritage from China. But here, people at the U.S. are definitely getting bearish on it.
Okay, Yu-Dee, tell us how this affects your investment strategy, especially when it comes to some of those large multinational stocks like Caterpillar and McDonald's.
Yeah, it does affect those a lot. Not only that, it affects the energy sector, it affects the base material sector, and in turn affects the currency sector. I think China right now is perceived to be the growth engine of the world, right? So if China doesn't grow anymore, or if it really starts to recede, then basically that's going to have a major effect. I think to us, large multinationals is something that we like and we've been liking for a while, for several reasons. I tell you, those companies, and those companies with good credit rating for that matter, right? Because these companies have footprints all over the globe. They're able to issue a lot of debt at a very low interest rate and be able to put that debt to work, especially in these emerging markets. Companies such as IBM, McDonald's, Procter & Gamble's. Now, they've been doing well too.
Are you selling them now, Yu-Dee? Are you purchasing them or are you selling them and letting them go, paring back your positions because of your worries about growth?
Yeah, I think that continue on with the same theme that I think on the short-term basis, we're actually selling them. We think they've done well for a while now. We think they're ready for a correction. Coupled with the news of the slowing down of growth in China, I think it's more prudent to take some money off the table, especially on those. So that's actually a major change in our strategy. Okay. It does affect our strategy.
All right, talk to us about asset classes now. With so much uncertainty out there, what's the best way to divide your portfolio?
Yeah, good question. I think, usually at time of uncertainties is where you want to diversify, right? So the asset classes we're looking at right now, still the equity market, no doubt, historically still a sector that does well. So looking at the equity market, we're looking to trade the metals market, not necessarily invest in them. And we're also looking at the asset class of precious metals, the one we're not looking at, I was going to say, is actually the so-called bond market. I think at this point in time, the bond market is just not too much yield to be getting. So we're really oscillating, we're diversifying ourselves between the precious metals, between the stock market, and also start to look into some real estate play, especially in the U.S.
That's an interesting point. Real estate in the U.S., is it recovering, or is it just that one section, the distressed properties that are selling right now? Nothing else seems to be really moving.
Yeah, but if you look at the home builders, especially the home builders stocks, they have had quite a move up since October. So that's a good question. A lot of people are asking, are the home builder stocks performance a precursor of the U.S. real estate to come? Or is it just that they've dropped so much and this is just a dead cat bounce? So that is the $1 million question to be answered. I think personally speaking, if you look at the U.S. real estate market, I think they're basically in pockets. You look at New York City, actually doing pretty well. Where I am from, Washington, D.C., we're up about 6%. You look at Florida, you look at Las Vegas, oh boy, they're still continuing its downtrend. So I think they're in pockets. It depends on which region we're talking about here.
Absolutely, and don't even talk about Detroit because they're really in a lot of trouble. Thank you so much, Yu-Dee Chang from ACE Investment Strategist, joining us throughout the full hour on Squawk. You can email us questions for him, the address squawk@cnbcasia.com. And remember, you can also keep up with what's happening on the show via the internet. As Yu-Dee was just saying, he's scared of the market going into April where the VIX is low. He expects a correction of anywhere from 7 to 15%. Do you agree with that? Let us know. My handle on Twitter is @LisaCNBC. Well, still ahead on the show, BlackBerry maker Research Emotion misses the street's expectations. We're going to have the details on that story after this break. Stay with us.
All right, a new Reuters poll shows that global investors cut their holdings in U.S. bonds to a 6-month low back in March as hopes of QE3 from the Fed faded. The survey, 55 leading investment houses from around the world showed on average their portfolios hold 36.9% in treasuries. That is down from 39.7% back in February. Equity holdings were up for a third month in a row, but a rise in cash shows investors are still cautious. Let's keep talking. Sam Chandon joins us, president and also chief economist at Chandon Economics, live out of our studios in New York. And across in D.C., our guest host stays with us, Yu-Dee Chang, principal and chief trader at ACE Investment Strategist. Gents, both of you, great to have you on the show and appreciate your time. Sam, let me start with you. The survey that we were just talking about, showing people are paring back holdings of treasuries on expectations and no, QE3 is not going to happen. Do you agree with that, A, and B? Does that mean then that, look, long yields are going to go up?
Yeah, I think you're right. What we see is that there's increasing evidence, and you get this from the kind of discussions, the kind of comments that are being made by voting members of the FOMC, the presidents of the regional feds. There's increasing opposition or concern within that group of people that, as conditions improve, as the data tells us that the economy is firming, the case for another round of quantitative easing weakens. And what you then see is a more serious discussion emerging about whether or not another round would introduce further inflationary pressures in the economy, and more importantly, whether it's starting to have distortionary effects on asset prices that are difficult for us to gauge at this point, but ultimately could become a problem a little bit later on down the road. Yeah. So it's not even just a question of people beginning to think that, conditions don't warrant it. You do start to see some comments being made from people who are saying, it's starting to have some unintended consequences for us.
Excellent. I wanted to talk to you about that, unintended consequences and maybe too much of a good good thing because it was just a couple of days ago we had the 10-year most closely correlated to, let's say, home mortgages up at about 240 or so. Not that much of a problem, but when we get into the maybe 3.5 area and you get 30-year fixed mortgages at 4.5, then you've got a problem. So, I mean, the Fed's intention, of course, was partly to push money into risk, to raise inflationary expectations. But at what point does this threaten the fragile recovery we've got so far?
Right. You're raising a critically important point, in particular because of the strong relationship that we're going to see between those risk-free yields and what's happening in the mortgage market. One of the key centers of weakness within the U.S. economy right now remains housing outcomes. I think Yu-Dee mentioned that there are pockets of recovery in parts of D.C., parts of New York City. But when you look at the country as a whole, this is a segment of the economy that remains very weak. And the challenge for us now is that there are a lot of people who might want to become homeowners, but it's difficult for them to qualify for mortgage credit, even though the price of the mortgages, the interest rates are very, very low. It becomes increasingly difficult, and we begin to see some erosion of that affordability as interest rates begin to rise. The real difficulty here is that even if we head to 3% range, by any historic standard, that's exceptionally low. But in the United States right now, I think we face a real problem. It's been a long time since we have had to manage with an interest rate environment that looks anything close to normal. And quite frankly, an extraordinarily low interest rate environment has become our drug of choice in this country. But the potential impact on the economy over the long run in terms of how it distorts the markets is potentially quite toxic. And so although we may be pretty happy about this, it's something we've ultimately got to back away from.
All right, Yu-Dee, come in on this.
Yeah, Professor, hi, this is Yu-Dee. I have a question for you. If you look, everybody says that Bernanke is a student, especially of the Great Depression, right? So do you think he's still very much on his mind saying that, I am just not going to prematurely raise interest rate to make it 1934 happens again? Would that be one of the major factors that's driving him try to keep interest rate lows for a while too?
Well, I think they are working aggressively to keep interest rates low. Unfortunately, and in spite of the independence of the Fed, as we move into a much more political period in the run-up to the election, the Fed does face difficulties of its own that I'm sure it's managing internally in terms of the optics and the perception around continued interventions. You see that there was an op-ed in the Wall Street Journal this week relating to some of the potential dangers of continuing interventionist monetary policy, not least of which is a market begins to form simply around this question of whether or not there will be another round of quantitative easing. And ultimately, it becomes very difficult for us to assess, what are outcomes if the private economy is allowed to function on its own? How many of the investments and what kinds of asset price trajectories do we observe that are sustainable based on the underlying fundamentals of what's going on in the economy? And how much of what we're seeing is really only a result of what's going on in the capital markets? And there's only so long that we can support pricings, pricing that we can help to buoy asset prices simply as a function of monetary policy, when ultimately that's masking some serious underlying challenges that we face. We may not want to back away because it's tempting to want to help keep those interest rates low. But ultimately, we reach a point where we've got to balance out the fact that the economy has to be able to run on its own legs.
Absolutely. Uncharted territory for both economists like yourself, Sam, and for investors as well. Thank you so much for joining us today. Sam Chandon from Chandon Economics, and we're going to have more with Yu-Dee Chang from ACE Investment Strategies in just a bit.